we have some massive news for Starbucks and Chipotle investors. The Starbucks CEO has been effectively ousted as of today, and he will be replaced by the Chipotle CEO from September the 9th, who has had a very strong track record at CMG. Now, there are no surprises for Starbucks investors, especially those that have been up to date with the more recent quarters where they have performed very poorly, and this is some very good news. Now, when we look at both sides of the coin, well, Starbucks, as we can see, up 22% on that news, now trading around $94. But on the other side, we have Chipotle Mexican Grill. Now, this is down nearly 12%, and the market has just opened. It currently sits around $49. Now, today we're going to do an in-depth dive of CMG. Is it a great time to buy? It does now trade in the mid, heading towards the lower end of the 52-week range, and we do get a buy signal from Wall Street, a double hold from Seeking Alpha and Quant, but we do point out, as we will come to see, the valuation does still trade at a premium. Now, over the last year has been very strong, up 51%. Over the last 10 years, it has significantly outperformed the S&P, up 313%. Now, when we take a look at this company, the underlying fundamental metrics, on the free cash flow, we want to see growth consistently over the longer term, moving in the right direction. And we note it has pretty much tripled from 2014 to 2023. Also nice to see, even though a small increase, it is expected to continue over the next 12 months. Now, sales growth also looking very good for CMG, nearly double digit every single year. Just the last 2 years consistently at 14%, over the trailing 12 month 15% as well. And for those that do like to see it from a numerical perspective, we can see from 4 billion to 10 billion, so more than doubled over the last 10 years. Now, what we also note is they have done some share buybacks, going from around 1.58 billion to around 1.38, which is always good, returning excess cash to investor pockets, as ultimately you do gain a larger control of that company. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. When we take a look, near enough that every single year, last 3 years looking very good and increasing, 22% in 2023 does make it very attractive for potential investors or for current investors to add more if they believe the valuation is right. Now, operating margin, we want a minimum of 16%. We haven't really seen that. In fact, very low in 2016, but it has been increasing from that point. So we do see some operating efficiencies. 16% in 2023, pretty much at the minimum level we want to see. Nice to note, on a trailing 12-month basis, 17% does look good. Then we get to the free cash flow margin, where we want to see a minimum of 5%. So that is very strong to see. Last 3 years as well in the low teens, a good indicator of this company. And finally, we get to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, this correlates to that balance sheet strength. We want to see below 3, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.73, so from the highs that we saw in 2016, it has been coming down. 1.13 in 2023, 0.95 over the next 12 months, so we can see the balance sheet does look strong, and we'll look at this in a little bit more detail shortly as well. Now, we also want to point out we have released our latest free weekly article. If you want access to this or any other articles, you can click on the pinned comment below, sign up and read straight away. And in fact, we have also released our 35 undervalued stocks to buy for the month of August, where we also talk about those that are within our own portfolio as well. So do click below to sign up. We also want to talk about insider and institutional ownership. Starting off with insider around 1%, we see around 68 million worth of sales by these insiders over the last year, with around 951,000 just in the more recent quarter and around 35 million in Q2. Now, as always, for transparency, we will show you who these insiders are, but ultimately we don't believe insider selling is a bearish signal. They sell for many reasons, whether it's personal or financial. And here we have an insider on the 6th of August, so just last week, sold around 17,000 shares and netted him just under $1 million. As always though, the information is there if you want to include it. within your own investment thesis. We then move on to institutional ownership, around 91%, fairly high, in fact one of the highest we've seen on the channel. 156 million worth of sales over the last year, but a significant amount more buying, in fact nearly 8 billion worth. In comparison, that is a very large difference, not one we do see regularly on the channel, and we can see in quarter two that is where the majority of the buys did come. When we look at it on a quarter by quarter basis going forwards, we can see the buys and sells are very small in comparison. So institutions must be very bullish at this point in time, but as always, never buy based on what they do or insiders. In fact, always do your own due diligence before executing. We then want to move on to the income statement. Now, we have run through the top line revenue, but we also want to focus on the bottom line net income. As we said, the top line from 4.1 to just under 10 billion, more than double over the last 10 years, and that is some very nice consistent growth on a year-on-year basis. Now, getting to the net income, what is the story to be told? In fact, nearly tripled their bottom line, 445 million in 2014, just over 1.2 billion in 2023, and on a graphical basis from around 2017, it has been fairly consistent in the uptick that we can see over the subsequent years. So overall, it does look good, both on the income statement basis as well as a balance sheet as we're about to show, and we focus on this to look at the health of the company, total cash versus total debt. 758 million in 2014, 1.5 billion in their latest quarterly report, so around double their cash than what they had 10 years ago, and pretty inconsistent on a year-on-year basis. Now, ultimately, this number in isolation doesn't tell us much, which is why we do focus on comparing it to their total debt, both numerically and directionally, and we can see it has gone from around 0 in 2014 to around 4.3 billion in the latest report. So over the longer term, similar to other metrics, it has been increasing. However, do bear in mind when we look to the net debt to EBITDA, over the next 12 months, it is anticipated to come below 1, which does tell us it does look fairly strong overall. Now, we want to look at the earnings over the last 4 quarters and future projections, and always great to see a company that has beaten analyst targets. That is 4 for 4, so 100% track record. Maybe gives you more faith that they will be able to meet those next targets that they have set, and looking very strong over the next 4 quarters. 3 of them double digit, and if they ultimately hit their December 2025 EPS estimate, the forward P, which is already fairly high, will come down to around 43. Now, a few other things we want to point out are some of their underlying metrics with their gradings, and they get an F. Really no surprises here, because when we look at it, around 51 currently, the sector median much lower at 14.95. So this tells us if you are buying CMG right now, you are paying a 243% premium, and something that is essentially told when we look at any other valuation method as well, you are paying a very large premium for Chipotle Mexican Grill. Now, sometimes it is warranted, it is justified to pay a premium. It is just coming to the understanding of what level of premium we should pay, which is where our valuation will come into shortly as well. So the next thing we're looking at is their growth grade, now a B+. So we can start to understand why they do hold that premium. 15% year-on-year growth, 2% for the sector, 14% moving forwards over the next year, 4% for the sector. And one of the main things to look out for here, earnings per share over the next 3 to 5 years, anticipated 22% increase year on year, much higher than the sector as a whole at around 10.61. So growth does look much better in comparison to the sector. And when we do look at the profitability, well, an A-, so that tells us the profitability should be much higher as well. Gross profit margin then 41%, sector as a whole 37%. Bottom line 13.2, and we can see so much better than the 4.61 from the sector. And the main thing to draw your attention here, 1.88 billion worth of cash from operations, 269 from others in terms of a sector median. Now, a quick wrap up for this part of the analysis: 1 buy rating from Wall Street with a double hold, an F on valuation, B+ on growth, and with an A- on that profitability. Now, how have they performed against others in the sector? Are there any trends that we can spot? We have Starbucks, Compass Group, DoorDash, as well as a few others. Majority of these we have covered on the channel. And over the last year, even after the drop, CMG is still up around 51%. And we do notice one of the best performing over the period. In terms of over the last 5 years, again, the best performing by quite some distance. And when we zoom out fully to over the last 10 years, again, we can see very strong. Now remember, although it has been a great performance, if you do believe that, for 262% return, always understand that past performance is not an indicator of the future performance. Now, before we move on, we want to have a quick look against the comparison versus the S&P. Now, over the last year, we can see it has outperformed the S&P, 35.86 versus the 19. When we look over the last 5 years, again, we can see the S&P significantly underperformed. And over the last 10 years, we can see even after the drop, CMG up 313 versus the S&P's 173. Now, ultimately, if you do have confidence over the next 10 years or whatever your investment horizon is that CMG can outperform, then it may be one to consider if the valuation is there. Otherwise, if you don't have that faith, maybe a low-cost ETF may be the way to go. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value of $56 in today's episode, we've got this by running it through the DCF model. We have the free cash flow year on year, the average growth rate at 36%, looking very strong just in the last year, 45%. And we've gone for 3 different rates, a low, medium and high, 15, 20 and 25, all of which are below the 10-year average and the increase to just 2023. So with the 20% rate and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, our undervaluation signal. So if you do believe that, that is around 12% upside. For those that believe that is way too optimistic and want to go lower, well, at 15%, just for transparency, it will come to an intrinsic value of $39, implying negative 22%, so downside effectively. For those that believe that is way too conservative, and in fact it should be a lot higher, at 25%, $79 mark would imply 58% upside. Now, as always, this is fairly subjective, so depending on what rate you believe, that will impact the ultimate valuation, and you can always grab a copy by clicking on the pinned comment below, running in your own numbers, whether it's for CMG or any others. So let's take the 20% to the next essential part of the valuation, and as always, we have a margin of safety. We start off with 10% and execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, look, if you believe that in today's episode, it is a buy at around $50, which is pretty much where it does sit right now. That might be enough for some people. In fact, a lot of people may say the valuation is still too high. At a 15% MOS, a buy around $47.50, at 20% around $45, and at that 25% level around $42. So today's episode, even after the drop, we only see a 10% margin of safety, and remember that is solely based on the free cash flows growing at around 20% over the longer term. So we're talking about a 10% MOS with Wall Street indicating upside of 28%. Their price target sits at $64. And as we said, they do have it at a buy rating. As always, let us know your thoughts in the comments below. Is this one maybe you're looking to buy on the drop? Maybe it's on the watch list, or maybe actually you're a shareholder and you are looking to sell. If you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to sign up to the free weekly newsletter and come and join us in the Patreon if you do want to discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.